What if the plane can't land? Hear me out on this. You're 8 hours into a transocean flight that should have lasted 6, and you still don't see land. Trust me, not only are the passengers going to be uneasy, but so will the pilots. If U.S. markets are the plane, then Jay Powell is the captain of this ship, and like it or not, he's trying to break the news to passengers that he can't find the airport. Welcome to the Money Runner. I'm David Nelson. That's the situation the Fed and investors have right now. The inflation picture, while improved from the dark days of 2022, is still stubbornly high. At least high enough that the Fed can't cut rates. Of course, the above has a direct influence on markets and investor expectations. Bulls and bears go into the ring every day to make their case, armed with dollars to back up those bets. And history shows that bulls are the favorite and usually the ones dancing around the ring at the end of the fight. But with each passing day, we burned a little more fuel, and the bear case takes on a little more importance. The last couple of weeks have been trying for investors. The increased hostilities in the Middle East haven't helped calm already frayed nerves. War is always a time of concern. Will it spin out of control? What does it mean for oil prices? And in turn, could it trigger a recession? All of the above are valid concerns, but the primary catalyst as to why stocks are struggling isn't war. Look no further than U.S. bond markets. Each tick higher in yields is a challenge to valuations. That's Stocks 101. Rates are rising at every tenor along the curve, and yet despite that, bulls still have some solid points to make. The bull case. We are in the initial stages of a massive technology revolution that's likely the biggest investment theme in a generation. The productivity bump that comes along with it will be a benefit to almost all companies, enhancing both revenue and earnings. We're, of course, referring to AI. Most of us are familiar with large language models, but that's really only the tip of the iceberg. We still have an economy that's growing, and while we're seeing cracks in the employment picture, which is distorted by mass migration, it is certainly robust enough that the Fed feels no pressure to cut. In fact, cuts are all but off the table for 2024, as Jay Powell told investors yesterday what they already knew. At a conference in Washington earlier in the week, Powell said, "The recent data have clearly not given us greater confidence and instead indicate that it is likely to take longer than expected to achieve that confidence. Even with that, markets can hold their ground and even push higher if rates hold steady." This is what the bears say. What stocks can't deal with is rising rates. Not at this stage of the cycle. The rate of change, no matter how small, is frightening because there's no indication of where it's going to end. A 10-year at 4.7%? What about 5%? How much Microsoft do you really want to own with rates at 6? Until rates stabilize, stocks are in the penalty box. We're already approaching levels where insurance companies, pension plans, endowments will be forced to pull money from equities and allocate toward fixed income. Volatility will increase with ever bigger price swings as the battle between buyers and sellers accelerates. Pick your spots carefully. Momentum as a factor has been struggling over the last month, a clear indication that markets are looking for leadership. It's going to be tough enough, even if rates hold their ground. Higher for longer creates an economic drag that certainly weighs on the consumer and ultimately economic output. We can get through that. It's not going to be easy, and there could easily be one or two black swans along the way. But rates on a continued path north, that's a different story. The administration and Congress need to rethink their priorities. Bond auctions are getting tougher. There is a concerted push around the world to reduce exposure to U.S. Treasury debt, which pushes yields even higher. Plus, as pointed out in last week's post, gold rising in the face of rising real yields, that's unusual. Some central banks may be swapping U.S. Treasury debt for gold. Many of the advantages we enjoy are in part the benefit of the U.S. dollar being the reserve currency. Today, there's a concerted effort around the world to end that privilege. BRICS countries increasingly do transactions in non-dollar currency. There are currently 9 nations in the alliance, with 40 other nations have expressed interest. All of this puts increased pressure on the G7. Here are the current members: Brazil, Russia, India, China, South Africa, Egypt, Ethiopia, Iran, and the UAE. Take a look at that chart again. Not a lot of friends in that picture. The United States can no longer take dollar dominance for granted. If you'd like to grab the charts or the transcript from today's pod, go to my Substack site, dcnelson123 at substack.com, and subscribe. It's free, just like this podcast. Please click the button here too. Thanks for joining. I'm David Nelson, and this is The Money Runner.